Growth in the Philippine food market is often measured in cheese, discounts, and delivery receipts. But for Figaro Culinary Group, real expansion lies deeper. In the first quarter of 2026, revenue surged nearly 15% year-on-year to 1.5 billion pesos, with 9-month sales at 4.7 billion pesos. The pace is impressive. Yet, the question investors must ask isn't simply whether Figaro is growing. It's how efficiently that growth is translating into profits. At first glance, gross profit tells a promising story. Margins edged higher, and direct costs remain controlled. But beyond gross profit, operating expenses climbed 18% in the quarter, outpacing sales. Finance costs jumped over 21%. As a result, net income rose by just under 3%, signaling a dilution in earnings quality. Over 9 months, operating costs soared 26%, finance expenses increased 32%, and net margin declined. This is the paradox. Expansion is fueling relevance, but also compressing returns. Angel's Pizza emerges as the true engine within Figaro's portfolio. It generated 71% of quarterly sales, 1.1 billion pesos, while Figaro Coffee and Tian Ma lag behind. This brand concentration brings mass market strength, but it places the company's fortunes in the hands of one banner. Meanwhile, geographic trends highlight NCR as the growth hotspot, with provincial sales stagnating. For nationwide ambitions, that gap demands attention. Investments are accelerating. Property and equipment now total over 4.2 billion pesos, with 8 new stores added in the quarter. The spending is essential for scale, but expenses, advertising, labor, and overhead, are rising faster than sales. Net margins slipped further, evidence that operational improvements haven't yet translated to bottom-line efficiency. Financial leverage is becoming more pronounced. Loans payable increased, lease liabilities are steady, and finance costs are climbing. Still, liquidity is sound. Cash and current assets outpace liabilities, and operating cash flow is positive. Figaro has signaled shareholder friendliness with modest dividends. But if expenses and debt service continue to absorb profit, dividend growth will be challenged. The optimistic view. Angel's Pizza is a winning brand. Revenues are ascending, margins are improving, and store rollouts continue. If promotional spending normalizes and new store economics mature, profits may rise in tandem with sales. The risk: growth could become more expensive, and heavy promotions or debt-funded expansion may hamper earnings. The next chapter for Figaro Culinary Group is demanding. Investors must look beyond sales, because the real test is how much profit each new pizza delivers.